Welcome to welcome to the show. Money in Jeez, I did it again. What's wrong here? Be the boss of your money. Welcome. I'm Mitch Goldberg, your host. You're here. All right. Thank you so much. The title of today's episode is Why Are Asset Allocation Clients, Investors So Disappointed This Year? What happened? Isn't asset allocation and isn't asset allocation supposed to be the end all and be all of investing? You were supposed to solve all of your risk tolerance questions and meet and help. It's a portfolio take that's supposed to help you meet your financial goals while keeping you within your risk tolerance and your rebalance. What exactly happened? Because right now, asset allocation investors are probably as disappointed as they've ever been. The returns have been subpar, and that's putting it nicely. So we're going to take a look at that and what is wrong with it, and if it's still worth pursuing, and if you are in an asset allocation model type of portfolio, should you make a change and maybe get out of that, and what really is working? Well, let's roll the intro. We'll talk about this and a number of other things. So once I find the intro, which I usually have teed up to go, and it's right here. So stick around. Asset allocation modeling. Why are investors disappointed so much this year? Here we go. All right. Thank you so much for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money, and just want to help you be better with your money. We talk about finance. We talk about interest rates. We talk about borrowing money, investing money. We talk about all of those things, all of the things that you need to know more about so that you could make the best possible financial decisions for yourself. Some knowledge is an important thing to have, and that's what we do here. We share the knowledge. If you're enjoying our content, certainly please give us a thumbs up or a heart or an applause reaction, depending on which social media platform you're watching on. If you're watching on YouTube, please consider subscribing. If you have any questions about what we're talking about, that's what the comments are for. Even if you're watching this in the replay, like if you missed the live, these episodes, they're always on my social media timelines, and they are on our YouTube channel. So if you miss it, all you have to do is just go there and watch it later. And if you have any questions, ask in the comments, and we'll see you later, and we'll get back to you. So let's just take a quick gander at the overall market and what happened today. So the Dow is getting back to 39,000. It's not far. We could be there in a couple of days. The stock market is closed tomorrow for Juneteenth holiday. It's a federal holiday. Banks, stock market is closed, and many other services. No mail tomorrow either. So NASDAQ rose to hit a high during the day. So did the S&P 500. When you're already in record territory, as you can see, they don't really have to go up 5 points and 13 points. They don't really have to go up a hell of a lot to keep hitting records. Gold, a little bit of a rebound. Oil is getting back into the low 80s. So we could see prices at the pump start to go up a little bit. We'll see. I don't know if it's really a matter of gasoline stockpiles. We do have plenty of gasoline sloshing around. And the driving season is, as far as gasoline goes, distributors have basically put their orders in already for the summer. So, there's going to be no problem with shortages or anything like that this summer. So I don't really see energy prices having a reason to go up a whole hell of a lot more than they already are, but we'll see. VIX is continuing to stay around 12, so it's pretty low, and that indicates a pretty complacent or comfortable or calm investor sentiment. There's articles today in the major media, financial news media outlets, in particular CNBC, that investor bullishness is at an it's up at record territory or near record territory. Asset managers have very low cash levels on hand, which is an indication of their bullishness. So investors are wondering, to be a contrarian, if everybody's so positive, maybe things are as good as they get. Maybe there's no more of that marginal last dollar to go into the stock market to keep the demand up for stocks, to keep them going up. Nvidia raced to a new record today. I mean, it split 10 for 1 when it was 1200. So let's say 120. Now it's in the mid 130s. And it's just the leaps from 120 to 130 in like what, a week? That's a really big move for a company like that. It's now the biggest company in the world, bigger than Microsoft, bigger than Apple. That's how big it's become. So as big as the artificial intelligence business market could be, and we haven't even seen the real use cases for artificial intelligence. It's one thing to have it with Facebook or Google or Microsoft, and they could test it on us and give us a couple of little services and help write an email or write a text, things like that. But just wait until you get massive adoption from the rest of the real world, like Walmart and Target and General Motors and Procter and Gamble and everybody else who became eventually internet savvy or internet companies. Now they'll become artificial intelligence companies. But that is a long process. That part is going to take a long time. Nobody really knows for sure whose artificial intelligence platform is really going to be the one that everybody uses. It's kind of like Microsoft as a platform. Everybody uses Windows. Almost everybody uses Windows. They use Excel. They use Outlook. It's just a massively used platform. Google has a platform. They've got Google Search. So everybody uses Google Search. Social media, the world belongs to Facebook. So there's just a massive amount of profitability when your particular platform, for whatever technology wave there is, if yours is the one that everybody becomes used to, that is globally adopted, then that is clutch. That's what everybody's looking for. That's the golden ticket to a multi-trillion-dollar valuation. So I adopt artificial intelligence strategies, I adopt investment strategies, and I adopt children as well. So I adopt pets. So I just, I'm a big adopter. Do you adopt? I'm an adopter. Don't shop, adopt. That's for dogs, not for kids right there, that last part, of which I have two. Anyway, 2 kids. I adopted, right? Did you know that about me? Maybe say something in the comments about you that we don't know about, that you're comfortable sharing. All right, so let's take a look at the main crux of this show today. Asset allocation models, because that was, asset allocation broadly means how much money you divide your investments between the stock market, the bond market, and some cash. So maybe you might have 5% cash, 35% bonds, and 60% stocks. So you'd be a moderate risk investor, so to speak, right? So you take the asset allocation model, risk tolerance test. It's 10 multiple choice questions. It spits out a portfolio. This is your asset allocation model, very diversified, different asset classes. By the way, diversification, that's a strategy that we use to mitigate risk, but it doesn't protect your portfolio from going down in a generally down market. So the reason asset allocation works for diversification is because, for example, if you have all of your money in a large cap stock fund, let's say the S&P 500 index fund, of which there are many you could choose from. So I'm just speaking broadly, an S&P 500 index fund. It's very heavily tilted toward technology, but there's 500 companies in it. There's more than 500 stocks, though, in the S&P 500. A little fun fact for you. And that's because companies like Google have a Class A and Class C share. Some companies have Class A and Class B shares. So there's like 504 or 505 stocks in it, but there's only 500 companies. Okay, just want to make sure you know that. So when somebody goes, "Oh, there's more than 500 stocks in it," it's only 500 companies. Just that a couple of companies have more than one class of share that is publicly traded. Okay, so let's move on. But if you have an S&P 500 index fund and you want to diversify it, what are you going to do? Buy the Nasdaq 100 fund or the S&P 100 fund? It's basically the same stocks. So maybe if you buy a mid cap fund, you'll have mid-sized companies in it, which are totally different than those in the S&P 500 fund. And you might buy small company stocks, which are also not going to be duplicated in the other funds. And that's when you start to get real diversification. And typically, small caps could do well, while large caps don't do so well, and vice versa, or mid caps or international. And the idea is over the long term, we expect all of these different kinds of stocks, small, medium, large, international. We do expect them over the long term to do pretty well because that's what they've done historically. So if they're all expected to do well over many years from now, that's great. But if they do well or poorly at different times, it helps to smooth out the volatility of your portfolio. Meaning, if you're just in the S&P 500, that's your entire stock allocation. If it goes up 20%, great. If it goes down 20%, great. You just ride the ups and downs. Long term, we expect the trend to continue up like it always has. But maybe while that goes down, small cap stocks could go up. So it helps the volatility kind of go like this. And we know that a lot of volatility, big ups and big downs over short amounts of time, is what spooks investors out of investing. So if we could find a way to smooth out the returns, we could possibly keep you invested through tough markets, bear markets, as well as bull markets, because over the long, investing long term is really the key to being a successful investor and meeting your financial goals, to grow your money potentially over time to meet a financial goal. Usually it's, the big broad strokes we talk about, like retirement, but there's lots of different financial goals. Maybe the goal for the boat, the goal for the home, the goal for the second house, the goal for college, for your children. There's so many goals, and we want to make sure we hit them, but we want to make sure that we give you a portfolio that you could stick with, because we believe as financial advisors that time in the market is really more important than timing the market. So people are typically excited about stocks. They're typically enthusiastic about stocks, and they typically are like that when the market's doing well, and they get into the market, and maybe the market does well for a little while, but eventually corrects, and they go, oh, no, I can't do this. I don't have the risk tolerance that I thought I had. I can't take the down markets. So that's why we try to figure out how people would act in a bear market as opposed to how people act in a bull market. It's pretty predictable how people act in either, bull or bear markets. So what we want to do is make sure we find someone's threshold of pain for how much would the market have to go down in, let's say, a 6-month period for that particular individual to bail out and then not get back into the market until things get better, which means the market goes back up and everybody's happy again. And the same people are making the same mistakes over and over. We want to break that cycle. Okay. So that's what asset allocation is. It's some bonds, it's different kinds of bonds, it's some stocks, different kinds of stocks, and cash. And the way you mix that up determines more or less what your potential return could be based on historical returns. I know, past performance is no guarantee of future performance. But, we've got about 100 years of data. The S&P was started, I think, 1926. So we've got almost 100 years of S&P 500 data. So we do find that cycles are pretty repeatable, not entirely predictable, except that we know markets do go up and down in long cycles based on things that are out of control, such as inflation, interest rates, geopolitical events, demographics, natural disasters, and other things that are just really not in our control. We like to think we have a lot of control as human beings, but we don't. As we get older, we realize we have much less control than we think we have. Okay, so what's the deal? So an asset allocation model could be, let's say, 20% large cap stocks, and you could use a popular exchange traded fund for that, and I'm going to go into these. So let's switch to the other screen here, and we're going to get into the heart of the matter. All right. I'm going to pull up this one. This is VOO. It hit a 52-week high. The symbol is VOO, so we call it the VOO. I know if you're a financial advisor watching this, you know what this is. Probably Most individual investors who use exchange traded funds and asset allocation models use this. It's the giant Vanguard S&P 500 ETF. As far as S&P 500 index funds go, this is one that I would be very comfortable using in clients' accounts, and in fact, I do. It's not a buy or sell recommendation. This is just a generic fund. We like it because it's got a good brand name like Vanguard, and we feel comfortable with it, and we know it's a low expense ratio. But it hit a new 52-week high today, and it is up for the year 15.45%. And that's the benchmark. That's how the S&P 500 is doing. You see that? Almost 15.5%. Let's just call it 15.5%. So as an investor, you might say, oh, this is a really good year in the market because you're hearing about NVIDIA, more than a double this year. You're hearing about other tech stocks like Broadcom, Microsoft. There are so many stocks that are doing so well this year, and you're hearing about these, and you might think you're doing better than you expect. And then you open up your account statement, you get your quarterly performance review, you go, why am I not doing as well? Well, first of all, if you're just following the indexes like small cap, mid cap, large cap, international, emerging markets, bonds, it has nothing to do with the financial advisor being wrong. It means you have an asset allocation model and you're just index investing in a specific mix. The only way to do better in an asset allocation model is to contribute more of that asset allocation model into the best performing sector. So maybe there's 5 sectors in an asset allocation model: small cap, mid cap, large cap stocks, international, and bonds. But typically you might have 20, 25% in large cap stocks. So you're keeping up with the market with this particular part of your portfolio that's invested in the VOO, S&P 500 index fund. But then you look at something like, let's say, mid cap stocks. And this is VO. The symbol is VO. I'm using Vanguard funds because these are very popular with my clients and probably with my entire audience. And they have their use cases. These are really good tools. They're just tools. If I'm using a screwdriver, I'll say this is a screwdriver. It's a really good tool. Okay. But what's it doing for the year? Well, it's only up not even 5%. So if you take your stock money, if it's all an S&P 500 index fund, you're doing pretty good, right? Up 15.5% this year. But if you divided that between large cap S&P 500 and mid cap, which is this one that I'm showing you on the screen right now, it's only up 5%. So it's lowering your average return. And then if you look at, let's say, the VB, this is the Vanguard blend between growth and value, the small cap ETF. It's a very popular ETF, probably more assets in this small cap ETF than any other small cap ETF. This one, year to date, is only up a little over 2%. So when you start to diversify away from just large cap stocks like the S&P 500, you're lowering your return because the other asset classes are not doing as well. Remember, the S&P 500 is being led by the mega cap tech stocks like NVIDIA, which, as we said at the top of the show, is now the biggest company in the whole world. All right. So if you don't own those individual stocks or an ETF that has those, you're not keeping up. The S&P 500 is like 30% tech. And if you add communication stocks, which are really tech stocks, but they say they're communication stocks, my feeling is the S&P 500 is more like 50%, 45% tech. If you include all of what you would consider the tech stocks like Netflix and Facebook. All right. So that's where I put this one here. And this is a small cap ETF that follows an index. So this is a popular one. Again, only up 2%. So it's lowering your stock market returns, which is why if you're diversified in an asset allocation model between small cap, mid cap, and large cap, you're not doing as well as you think you would just because of the way the indexes are working. And then if we take a look at, let's say, EFA, this is from iShares, EFA. This is a very popular, I would say the most widely used international developed market fund that investors buy. Let's just look at the year to date, only up 4.11%. And then you go to the emerging markets, EEM, which is, I think, the most popular investment for investors who want to invest in Emerging markets. This is an emerging market ETF. Okay, it's again the iShares Emerging Markets ETF, and this one is only up 6.6%. And then you look at the big bond fund, BND. This is the all-encompassing Vanguard Total Bond Market Index. It's the biggest bond fund in the industry, in my industry. And even though interest rates have stopped going up and the Fed is expected to cut rates, year to date, it's down almost 1.25%. And short-term bonds, this is the big short-term bond index fund. This one is down 0.3%. So you see what's happening. It's one thing for the S&P 500 to be up a certain amount, and you keep hearing about that. Your record, everybody's up, everybody's happy. But if you are an asset allocation model investor, a pie chart investor, you could see that when only 20 or 25%, assuming you're allocating that much money to the S&P 500 index, you could see why your overall portfolio is not keeping up with the market, because all of the other asset classes are not doing as well. And as we just saw with the bond market, those two bond funds, they're very widely held. I'm sure many of you own them. Those are down on the year. So this is why asset allocation model investors are disappointed. So the question is, that's not what I wanted. The question is, should you, see a little camera switch, should you stay with your asset allocation model, or should you say, this is wrong, why don't we just put all our money into the S&P 500 index fund, since, excuse me, should you stick with your asset allocation? So the question is, should you stick with your asset allocation model, or should you commit more of your allocation into the S&P 500 index fund, because it looks like you would be doing much better? Well, I think it would be a mistake to get away from your asset allocation, because what you would really be doing is you'd be chasing performance. And chasing performance means you're riding momentum and you're getting out of your risk tolerance. So when the S&P 500 turns, if you have too much money in that, you're taking a lot more risk and you're diversifying a lot less. And those are the risks that you're trying to mitigate, but you're giving up upside. And isn't that what diversification is all about? You want to mitigate your risk, and by doing so, you're making a compromise. You're giving up upside potential. Now, if you have an asset allocation model between stocks and bonds, you should still be up this year. You're just not going to be up as much as you may have thought, because all you hear about is the S&P 500. You go, well, isn't that the benchmark? Shouldn't I be comparing myself to the benchmark? No, you shouldn't. Unless you're 100% invested in stocks, you should not be comparing yourself to the S&P 500. The whole point of an asset allocation model is to not invest in the same asset class, either just large cap or just small cap or just bonds, for example. The idea is to spread it around. And as one goes up and becomes a bigger proportion of your portfolio, and another asset class maybe doesn't do as well or goes down and becomes a smaller part of your asset allocation portfolio, the idea is to rebalance them. The idea is to rebalance them and take some off the one that maybe was 25% of your portfolio. Let's say now it's 30% of your portfolio, and another one was 20% of your portfolio. Now it's 15% of your portfolio. Move that 5% from the higher one to the lower one and bring them back into line, back to alignment with what you originally set out to do. That's what an asset allocation model does. It's supposed to help you mitigate the risk, and it really is supposed to just keep you exposed based on varying degrees, based on your risk tolerance, to managing a portfolio for you. So I think it would be a mistake to give up on an asset allocation model, and I think it's a mistake to go from being a conservative or moderate type of risk tolerance client to an aggressive client and say, well, why don't I just buy some individual stocks if we know they're going up? First of all, we don't know if they're going up. Well, if you think the stocks, it's one, I don't go by what I think. I go by what I can control to help you meet your financial goals, potentially meet your financial goals. But I don't want you to go by what I think. I don't want to go by I have a feeling. That's not the way professionals work. As an amateur, you could say, I have a feeling this is going to go up, or I have a feeling that's going to be good, or I have a feeling that's going to go down. That's okay if you want to invest like that. But for a professional, we don't go by that. We're going by data, and we're going by your risk tolerance. We're going by how long it is until you have to use that money, your time horizon, okay, and convert your investments into cash to pay for your financial obligations. These are the things we're going by. So I hope this explains why asset allocation investors are disappointed this year. I don't think it makes sense to give up on it. This is just a moment in time, and we expect eventually the other asset classes should do well while the leading asset class doesn't do as well. And the reason I say that is because it's always been like that. There are other asset classes that often do well and do better than large cap asset classes. It's just that it switches all the time and it's random. We don't know which years which asset class is going to do well, but we know eventually they all should do well. Thank you so much for watching. I greatly appreciate your time. Again, if you have any questions for me, ask me in the comments. If you want help, reach out to me. We can set up a phone call or an in-person meeting or a Zoom, and I would love to hear from you. Thanks again, and I'll speak with you soon.